Negative interest rates are irrational. Let's have a look. Hello everyone, Florian Heise here and welcome to another episode of Heise Says. I thought we'd look at something a bit different today. This is an article from the Mises Institute written by Jeff Deist, and it is to do with negative interest rates. And I thought it was quite interesting just because what he draws upon right at the beginning about this Bloomberg terminal software, a piece of software that people use, and just how this whole concept of negative interest rates is completely irrational and it doesn't make any rational sense. It throws all of the traditional economic theories about rational actors, people making decisions rationally, which I don't really agree with, but it throws that all on its head. It throws it all on its head. So let's have a look. Negative interest rates are the price we pay for de-civilization. So he makes some bold claims here. So Bloomberg terminals, a financial software system used by countless analysts and traders around the world, has a problem. Its system cannot price callable bonds using negative interest rates. Programmers never considered such a scenario and thus failed to code the system accordingly. So users get an error when they attempt to force negative bond yields into their machines. Okay? So the programmers who developed this piece of software, which is a widely used package, I mean, you wouldn't think that you'd need to allow for negative numbers. So it just shows you how irrational it is. Calculation error is an apt metaphor for the state of central bank policy. Both Europe and Asia are now awash in $13 trillion worth of negative yielding sovereign and corporate bonds. And Alan Greenspan suggests negative interest rates soon will arrive in the US, despite claims by both Mr. Trump and Fed Chair Jeremy Powell concerning the health of the American economy. Because it's all going good. It's all going good. That's just cutting these rates. It's just a preemptive measure to make it even gooder. Gooder, is that a word? Kofefe? So, with another quarter point cut in the Fed's rates below even a measly 2%. Oh wait, so they're moving closer to negative territory today. Negative interest rates are just the latest front in the post-2008 era of extraordinary monetary policy. They represent a Hail Mary pass from central bankers to stimulate more borrowing and more debt. That's what it is. Though there is far more global debt today than in 2007. Stimulus is the assumed goal for all economic policy, both fiscal and monetary. Demand-side stimulus is the mania bequeathed to us by Keyes, or more accurately, by his followers. It is the absurd idea that an economy prospers by consuming and borrowing instead of producing and saving. Negative interest rates turn everything we know about economics upside down. Under what scenario would anyone lend $1,000 to receive $900 in return at some point in the future? Well, yeah, that's essentially where it is. And this is where the risk of the cash ban in Australia. It means that, you can protect yourself from negative interest rates by just holding cash. And even the cost of storing it would probably be better than some negative interest rates at a point. But the IMF has strategies to deal with that. And I will link to the video I discussed on that right here. And I'm just going to write down the time so I will not forget, because putting those cards in, I often forget. But yes, I'll link to that blog post about the IMF's negative or strategy for dealing with that eventuality. The cash ban, frankly, wouldn't be necessary if they use this IMF policy. So only when the alternative is to receive $800 back instead, due to the predicted inventiveness of central banks and governments. So there you go. You'll only invest in $1,000. You'll only invest in this deal up here if there's a worse one on the table. Only then would locking in a set rate of capital loss make sense. By capital loss, I mean just that. When there is no positive interest received, the principal itself must be consumed. There is no market for negative rates. The future is uncertain, and there is always counterparty risk. The borrower might abscond or default or declare bankruptcy. Market conditions might change during the course of the loan, driving interest rates higher to the lender's detriment. Inflation could rise higher and faster than the agreed upon nominal rates. The lender might even die prior to repayment. So, these are all the risks that you take. Positive interest rates compensate lenders for all this risk and uncertainty. Interest, like all economics, ultimately can be explained by human nature and human action. If in fact negative interest rates could occur naturally without central banks or state interventions, then economics textbooks need to be revised quickly. Every theory of interest contemplates positive interest paid on borrowed capital. Classical economists and their real theory say interest represents a return on capital, not a penalty. Capital available for lending, like any other good, is subject to real forces of supply and demand. But nobody would sell their capital by giving the buyer interest payments as well. They would simply hold on to it and avoid the risk of lending. It seems insane. It really does seem irrational. It seems unnatural. And this is the state where we've reached now in the world, where this is actually happening. So this just tells you, doesn't it? Does it scream any confidence to you? So Marxists, of course, think interest payments represent exploitation by capital owners lending to needful workers. The amount of interest paid in addition to the capital returned was stolen from the debtor because the lender did not work for it, ignoring, of course, the capitalist risks. This happens all the time. All the time. People, particularly employees who are shutting down Cold Rock and other business, making businesses unaffordable because they want all these penalty rates because they deserve it. And all this rubbish about stolen wages when businesses are struggling to exist. People don't appreciate the risks involved in running a business. They don't appreciate the fact that the people are stepping up and assuming those risks. But how could a borrower be exploited by receiving interest payments for borrowing, i.e. repaying less than they borrowed? I suppose Marxists may in fact cheer the development of negative rates and perversely see them as a transfer of wealth from lenders to borrowers, when in fact we know cheap money and credit overwhelmingly benefit wealthy elites per the Cantillon effect. So they need to drastically rethink their theory on interest. So Austrians stress the time element of interest rates, comparing the lender's willingness to forego present compensation against the borrower's desire to pay a premium for present consumption. In Austrian theory, interest rates represent the price at which the relative time preferences of lenders and borrowers meet. But once again, negative interest rates cannot explain how or why anyone would ever defer compensation without payment, or in fact pay to do so. Of course, it must be noted that rational purchasers of negative yield bonds hope to sell them before maturity, i.e. they hope bond prices will rise as interest rates drop even lower. They hope to sell their bonds to a greater fool and generate a capital return. They are not buying the obligation to pay interest, but the chance of reselling for a profit. So purchasing a negative yield bond may make sense as an investment versus institutional and central bank bond buyers, which frequently hold bonds to maturity and thereby literally pay money to lend money. But if and when interest rates rise, the losses of those left holding $13 trillion of bonds could be staggering. In the meantime, a huge artificial market for at least nominally positive US Treasury debt grows, strengthening the dollar and suppressing interest rates here at home. This is the author is American. Once again, the dollar represents the least dirty shirt in the laundry. Congress loves this, of course, because even 5% rates would blow the federal budget to smithereens. Raising rates would cause debt service to be the largest annual line item in that budget. ahead of Social Security, Medicare, and defense. So we might say Congress and the Fed are in a symbiotic relationship at this point. The rest of the world might call it America's exorbitant privilege. Negative interest rates are the price we pay for central banks. The destruction of capital, economic and otherwise, is contrary to every human impulse. Civilization requires accumulation and production. Decivilization happens when too many people in a society borrow, spend, and consume more than they produce. No society in human history previously entertained the idea of negative interest rates. So like central bankers, we are all in uncharted territory now. Our job, among others, is to bring the insight of Austrian economies on economics, on money and banking to widespread attention before something truly calamitous happens. I'm saying economies all the time when I should be saying economics, but you know what I mean. So this is a very interesting take on it, and it really does not make rational sense that we're having this negative interest rate. So guys, let me know your take on it. Do you think negative interest rates make sense? Do you think they would exist if it wasn't for central banks and governments? I wonder. I think we all know. Anyway guys, thanks for watching. Like, share and subscribe, and I'll talk to you next time. Take care.